Hello, and welcome to our Market Alert video for today, which is March 8, 2024. I am Ken Moraif. I'm the CEO and founder of Retirement Planners of America. I'm coming to you from snowy Colorado, actually here to ski with my family. We got 24 inches of snow in the last week and another foot expected over the next week. So my goodness, the snow conditions are unbelievable. My grandson, my 3-year-old or soon-to-be 3-year-old, is coming, and it's going to be interesting to see his first time ever on skis, how he takes it. His mother did not take it well, I can tell you that right now. Anyway, our firm, Retirement Planners of America, our singular goal is to create as many SCWPers as we possibly can. And if you don't know what a SCWPer is, it is the acronym for Second Childhood Without Parental Supervision. We want our clients to go play, have fun, be a kid again, and don't worry about all this boring financial stuff. Let us do it for you and be a SCWPer. So our website is RPOA.com in case you didn't know. So let's go over with what happened this week. Well, two of the most important people in the entire world when it comes to the markets and finances spoke this week. Jerome Powell, our Federal Reserve Chairman, and Christine Lagarde, who is the equivalent for the European Central Bank. Both of them, I kind of get the impression that they talk with each other, even though they say that they don't, and they, everything they do is independent, and we take care of our own, and, they do what they want to do. But they would both had kind of the same message, and that is we need to have more confidence before we're going to lower interest rates. But our confidence is increasing. And we have more confidence now than we did several months ago. And they both said that exact same thing. So it's kind of interesting. But also, obviously, it begs the question, well, what is it going to take for you to have the confidence? And the answer is, well, we don't know. We'll tell you when we have it. So it was kind of comical, but, they're human beings. They're looking in their crystal ball, and they're trying to use data to predict the future. It's not very easy. So, my heart goes out to them. It's a difficult job, but I found that to be comical. So why do we, so our fearless forecast, as you guys know, is that we think that the Fed will start lowering interest rates no sooner than July. We got jobs numbers this morning, and they came in very hot. The expectation was 200,000 jobs. It was actually 270,000, so significantly higher. And that feeds into the narrative that inflation could be impacted by these jobs. People with wages spend money, and if they spend money, that could drive inflation. So because of that, we think the Fed will not be as anxious to start lowering interest rates yet, which feeds into the narrative of our fearless forecast. So we think that that's going to be in the second half of this year. So why do we care about all of this? Well, a couple of reasons. One is if you're over 50, which is people we work with, and you're probably diversified, at least I hope you are, and maybe you have stocks and bonds in your portfolio. And if that's the case, what the Fed does affects both sides of that coin, right? The bonds and the stocks. So when the Fed raises interest rates, bond values tend to fall. And as you guys know, we went through one of the worst bear markets in the history of bonds. And we also, if you've been watching these videos, told you in April of 2022, get out of bonds, sell, sell, sell. And if you followed our advice, then you missed out on most of that terrible bear market, the worst, as Bloomberg said, in history. So we're back in bonds now. Why? Because we think the Fed is going to start lowering rates. And when they do, we think we should have a historic rise in bonds. Now, when the signal to go, when they fire the gun for the races to start, we don't know. That's why we're in now. And we're anticipating that by the end of this year, bonds will have done very well. On the stock side, why do we care what the Fed does there? Well, because if inflation's coming down and the Fed lowers interest rates, then what does that do for the consumer? Well, the consumer now has more money to spend. Inflation is lower. And money is cheaper. They can borrow at lower interest rates on credit cards and car loans and home mortgages and all that kind of stuff. And so they go out and they spend money. And if they spend money, what does that do to the profits of companies that are selling them all that stuff? Goes up, right? And if profits go up, that is, in our view, what drives stock prices. And we've said that, inflation, unemployment, all those things are important. But what really drives the market is profits. You could have a company that's profits are going up and up and up and up, in a severe recession, when there's mass unemployment, all of that, their stock will go up. And conversely, you could have a company that in boom times, but their profits are dropping like a stone. Guess what their stock price will do? So we believe profits drive stock prices, and with cheaper money and lower inflation, more profits, stocks should do well. So this is going to be, in a good way, a very, very unusual year in our view, and that is stocks and bonds should both go up at the same time. That doesn't happen very often, but thankfully, we think it's going to go up at the same time. Now, what should we be worried about right now? Well, one of the things that Warren Buffett is famous for is saying that when everyone's brave, I'm a coward, and when everybody's a coward, I'm brave. And so one of the things that's happening right now is that the market has, over the last 6 months, had a rise that we haven't seen in 50 years. And so what's driving that is, to a great degree, is technology companies who are involved in AI and artificial intelligence. And that, of course, is the thing that everybody's excited about right now. It's going to make it cheaper and faster and more efficient, and we're going to have profits go up, and therefore, we should invest in these companies. Well, this is eerily familiar. Some of you may remember Y2K. Guess what? Back then, we had technology companies. At that time, of course, it was the internet. The internet's going to change everything. It's going to make life cheaper and more efficient and faster and more profitable and all that. And sure enough, it did. The internet did all that. But back then, investors exhibited irrational exuberance, as Alan Greenspan called it. And so is that what we have today? My question to you would be, do you have a strategy to protect yourself if that's the case? Now, we don't think we're in a mode of irrational exuberance yet, but we do think that it could happen, because we're starting to hear, if it has artificial intelligence associated to it, if it's AI, people are dumping money in. They want to get on the gravy train, and invest in this. And we don't know who's going to win, so we're going to throw money at everything. Well, that's irrational exuberance. And in Y2K, the market went down 49%, the S&P 500 index. So we believe you should have a strategy to protect yourself from that kind of a thing. And in our firm, we do. We call it Invest and Protect. The strategy that told us to sell in November of 2007, before the big market crash of 2008, told us to sell in March of 2020, the day before the pandemic was announced. And you know how far down the market went after that. And in 2022, when all this inflation stuff happened, it told us to sell as well. We want to protect our clients from big, bad bear markets. And we'd like to do that for you too. So check us out and see what you think. Anyway, so for this year, we do think that it's going to be a good year. Both stocks and bonds should do well, but always have a plan to protect against the downside is our view. Thanks for watching. Share this video with as many of your friends and family as you'd like. We want to help as many people become SCWPers. And if you don't know what that is, SCWPer is an acronym for Second Childhood Without Parental Supervision, as I said. And we want you to be one too if you can. So check us out, and thanks for watching.